Look, these markets are coming undone right now. We have seen some absolutely crazy volatility in both gold and silver over the last couple of weeks. Silver alone dropped 30% in a single day. That is the biggest one-day decline since 1980. So the question on every investor's mind right now is simple. Do we sell and move on? Or do we treat this pullback in gold and silver as the buying opportunity of a lifetime? To help answer that question, we have put together a free virtual silver conference going live Saturday, February 14th at 8 a.m. Eastern Time. You will find the registration link in the show notes below. Our speakers include John Chapalian and Maria Smirnova from Sprott Asset Management, Michael Oliver from Momentum Structural Analysis, Mike DiRienzo from the Silver Institute. Companies presenting include Aya Gold and Silver, Dolly Varden Silver, Abra Silver, Skeena Gold and Silver, Wheaton Precious Metals, and we have more announcements coming. So once again, a completely free virtual silver conference, February 14th, 8 a.m. Eastern. If you cannot join us live, no problem. You will receive a replay link after the event. Registration link is below in the show notes. I hope you can join us. Good luck in the markets. Now let me set the stage for what we are seeing across markets right now, because this is not just about silver. Software companies have gotten absolutely pounded because of AI replacement fears. Bitcoin is down 50% from its October high, and frankly, it looks like it wants to go lower. And silver just had its biggest single-day drop since 1980. I want to cover all of these sectors today, but the first one I want to dig into is silver. Now, full disclosure, I have been long gold for the last 2 years, and that has worked out very well. But I have had very little exposure to silver. It just ran away from me. It went too far too fast. And now we have had this significant pullback. So the critical question is this a buying opportunity? Based on all the work I have reviewed, and I am drawing heavily here from momentum structural analysis, relative performance analysis, and macro trend work, the answer is yes. This is a buying opportunity. Let me walk you through the reasoning. When you look at the macro trend of the monetary metals, gold, silver, gold miners, it is thumbs up across the board. And within that asset category, silver is outperforming gold. Now yes, silver got absolutely hammered, but here is the critical detail most people are missing. That entire drop lasted just 1.5 days. Most of the decline happened literally within hours. We spiked out the low, and it quickly came back up. A lot of people looked at that drop and said, that is it. It is over. You do not have that kind of crash without forming a major top. But that is not what the data shows. Long-term momentum trend factors are not even near points of structural breakage. This is key. When we formed major tops in the past, 2011 for example, or the major low in 2015, there was ample structure on the momentum charts. You could look at those charts and say, if you break that line, you are going down. Right now, we do not have any such structure nearby. And here is the rule I follow. Whenever you do not have clear structural levels to break down through, you probably are not at a top. 95% of major tops have clear momentum structures that, when broken, price follows. We simply do not have that setup right now. So the assessment is clear. Silver got trounced. But this is a buying opportunity, especially for investors who missed the first move. And the price target? $300 to $500 for silver, this year, with much of that move likely occurring by summer. I know that sounds extreme, but it is not crazy when you understand the historical precedents and the technical setup. There are many examples of other markets doing similar repricing events when adjusting to a new reality. Silver has multiple arguments supporting this kind of rapid readjustment, both technical and fundamental. Full thumbs up. This is a buying opportunity. Now let me explain exactly why a $300 to $500 silver target is not as outrageous as it sounds. Because I know, hearing that number, your first reaction is probably skepticism. Let me give you multiple lines of evidence. First, historical precedent from other commodities. Silver has lived in a half-century trading range between roughly $4 and $50, back and forth for 50 years. While almost nothing else in the commodity world did that. Look at copper. Copper lived in a similar compressed range, 50 cents to $1.50 per pound, from the 1970s through the 80s, 90s, and into the 2000s. Then, in late 2005, copper simply said, I am done living in this range. And in a couple of quarters, boom, it went to $4.50. No nuclear headline driving it. It was not even in sync with gold or silver or other base metals. It just repriced to a new reality. A couple years later in 2007, lead did the exact same thing. Lived in a compressed range for decades, then said, "I am out of here." Quadrupled in roughly 2 quarters. Silver is doing the same thing right now, breaking out of a 50-year box. Second, the silver to gold ratio. This is one of the most compelling data points. Look at silver as a percentage of gold's price. Last year, silver was at just 1% of the price of gold. 1%. Now go back to the bull market that peaked in 1980. Silver reached 6.5% of gold's price, and not just a spike, it sustained that level. In the 2010 to 2011 bull market, silver reached over 3% of gold's price. So we went from 6.5% to 3% to just 1% last year. That ratio recently broke out above 2%, pushing through a massive, clear technical ceiling on the relative performance chart. Silver is waking up relative to gold, and it has enormous room to run. Third, gold's own bull market math. Let us look at gold, the mama monetary metal. Gold has had 2 major bull markets since being legalized in 1975. From the 1976 low to the 1980 high, an 8-fold gain. From the 2001 low to the 2011 peak, another 8-fold gain. Different time frames, same dimension of move. Gold made its bear market low at 1050 in 2015. Right now, we are only 5-fold above that level. Gold has not even matched the performance of its prior 2 bull markets, and the fundamental drivers today are far more extreme. If gold simply matches those prior 8-fold gains, it reaches $8,500. And by the way, JP Morgan just recently came out with the same target number. Interesting timing. Now, if gold reaches $8,500 and silver simply returns to 3% of gold's price, which is where it was in 2011, that puts silver at roughly $240 to $250. If silver reaches the levels it held relative to gold in 1979 and 80, that 6.5% ratio, you are looking at numbers approaching $500. Fourth, monetary degradation. Look at an M2 money supply chart. Go back to 1980. Go back to 2011. See where M2 was then and see where it is now. If silver were simply to match the monetary degradation, to be worth in real purchasing power what it was worth at those prior peaks, it would need to be in the several $100 range. Fifth, the price chart itself. There are 2 ways to look at silver's chart. On an arithmetic scale, dollars on the left side, you have got that 50-year range that is about $45 thick, $5 to $50. Classical swing objective? Add that range to the breakout at 50, you get $95. And look what happened. When silver reached $93 to $95 a couple weeks ago, there was a huge fight. Sellers showed up saying, "Swing objective met, time to sell." They got a brief pullback, and then silver blew right through, running to 121. So the arithmetic swing objective proved invalid. But on a logarithmic scale, the proper way to measure percentage moves, the picture is entirely different. The low of the range was $4 to $5. The high was 50. That is a 10-fold gain from bottom to top. Add a 10-fold move to $50 and you get $500. So from multiple independent angles, historical commodity precedent, the silver to gold ratio, gold's own bull market trajectory, monetary degradation, and logarithmic chart analysis, they all converge in the $300 to $500 range. And one final point. When markets correct for decades of mispricing, they do not do it incrementally. They have a tantrum. They burst upward to correct the error, and they often overshoot what is fundamentally justified. If $300 is justified, do not be surprised if it overshoots to $400 or $500 before correcting. Now, I know what a lot of you are thinking. The volatility in silver is frightening. Gold is much more stable. The gold market is larger and more mature. To see gold move 10% in either direction is very rare. But silver? We saw it rip 70% in the first few weeks of this year, then drop 30% in a single day. That is genuinely concerning on the surface. I understand that. But here is how I frame it. From an investment-grade perspective, and I am talking about a 6-month or longer time horizon, silver is the place to be by every metric available. It will likely continue to outperform gold as it already has. A year ago, silver was 1% of gold's price. Now it is 2%. That means silver has more than doubled gold's return over the past year, even including this brutal pullback. The critical question is always, what was your entry point? If you chased silver at 120 because you finally believed the story, yes, you got caught. That happens to late entrants in every bull market. But the major buy signal levels were last June near $35 and at the close of November in the 50s. From those levels, we gave back some profits, but the core thesis remains completely intact. Let me play devil's advocate here because this is the question I keep getting. The last time silver had a move like this, a 30% single-day decline, was March 27, 1980, when it dropped 63% in one day. In the ensuing months, silver eventually lost 70% of its value from the peak. So, is that happening now? No, and here is why. That 1980 crash came at the top of the old range. Silver had just run from $5 to $50, a tenfold move, and it was still trapped in that same range it had traded in for decades. The move was entirely within the box. Today's situation is fundamentally different. We are only 2 months and 2 weeks into what looks like a multi-quarter surge. The breakout of silver versus gold on a spread basis happened at the close of November. This correction came at the end of just the second month, earlier than expected, but far too early to be a terminal top. If we were 6 months into this move and silver had reached $400 or $500, then yes, I would expect a sharp correction from there, but not back to $50. The old reality is gone. The question now is where silver will define the extreme upper end of the new reality. And even looking at the short-term momentum indicators, daily momentum has already crossed a buy trigger level. It is saying, hey, I am out of the hole. Weekly momentum offers confirmation levels just a few dollars above current prices. Nothing has broken other than public sentiment. And sentiment, while painful in the moment, is not structure. So if you are not in silver, view this as your opportunity. You are buying off the recent low. You are buying well below the recent high. Use this pullback. Quick reminder, we have our free virtual silver conference coming up Saturday, February 14th at 8 a.m. Eastern Time. Registration link is below in the show notes. Our speakers include John Chapalian, Maria Smirnova from Sprott Asset Management, Michael Oliver of Momentum Structural Analysis, Mike DiRienzo from the Silver Institute, Randy Smallwood of Wheaton Precious Metals, Benoit LaSalle of Aya Gold and Silver, Sean Rusin of Dolly Varden, John Miniotis of Abra Silver, and we have more speakers to announce. Saturday, February 14th, 8 a.m. Eastern. Registration is free. Link below in the show notes. Now what about gold? Is the move going to be measured or also explosive? Relative to the last decade, gold has already become far more volatile than its historical norm. We have seen $100 daily moves, sometimes $200 in a single session. That kind of volatility was unheard of just a few years ago, and it is going to stay elevated. Gold will lag silver in terms of upward dynamics, but it is still heading meaningfully higher. And I want to make an important point about silver's monetary heritage. While gold has a 3,000-year tradition as money, so does silver. India has recently remonetized silver, allowing it in bank transactions. Most people view silver as the industrial precious metal, but it is in fact a monetary metal. It has been for thousands of years, and it is being reborn now precisely because it is vastly underpriced relative to its monetary sibling. Now let me shift gears to something that is going to be controversial: Bitcoin. A lot of the crypto community loves to refer to Bitcoin as digital gold or the new gold. I want to address the price action we have seen over the last couple of months, because to me, it looks like Bitcoin is breaking down in a very significant way. Bitcoin peaked in October at around $127,000. As I am speaking today, we are trading in the low 70s. This collapse was anticipated months ago using momentum structural analysis. After that October-November high, 2 major sell triggers were identified, one at 107,000, one at approximately 102,000. When those levels broke, Bitcoin dropped immediately to the low 80s. Then it spent a couple of months trying to hold that level, which was expected. A midpoint pause. Not a buying opportunity, just a temporary floor with futile rallies. Then about a week ago, it broke through 82,000. The minimum target stated months ago, when Bitcoin was well above 100,000, was $60,000. The low last week? $60,005. Right on target. And it got there in crash-like fashion, actually. 2 separate crash-type events. Any rally right now up to the 75 to 76,000 zone is likely a selling opportunity. That rally will not hold, and ultimately I do not think 60,000 will hold either. Ethereum has been even worse. Many people assumed Ethereum would behave differently from Bitcoin. It did not. It not only followed Bitcoin down, it did worse. Ethereum's recent lows are basically at the lows of the last 5 years. Anyone who bought Ethereum over the past decade is essentially wiped out. I would not be surprised to see much lower prices, and I would not be surprised to see Ethereum become almost non-existent as an asset. Here is the bigger concern. This is not just a bear market in an existing asset class. This could be sufficient to bust the entire notional bubble of what cryptocurrency is, or was, to the point where it is no longer considered a viable asset category. And the consequences extend beyond crypto-related companies. Over the last 5 years, traditional companies you would never associate with crypto, got involved. They are now vulnerable. We could see headlines about losses from companies you do not even correlate to cryptocurrency. There are roughly 150 Bitcoin treasury companies, the biggest being MicroStrategy, sitting on approximately $8 billion of debt that was used to buy Bitcoin. Their average purchase price is around $78,000. We are trading below that right now. This is a busted bubble. This is a Tulip moment. And honestly, I do not know what is on the other side of it. Now let us talk about crude oil, because this is a market that looks very constructive to me despite all the bearish headlines. In fact, I have recently gotten long several oil-related ETFs. Here is why. Crude oil had a big surge in the 2020 to 2022 commodity rally, reaching $130. Then it backed off hard and has spent the last 3 years laying in the gutter, $60, $70, $80, sometimes dipping into the mid-50s, just dead. During that time, all the fundamental analysts have been saying oil is going to $40. They have never been more certain. But here is what the momentum analysis shows. Last month's close triggered a long-term momentum breakout on crude oil above $63. This is not a price chart breakout. It is a momentum-based breakout which historically leads price. After that kind of breakout, do not be shocked if oil surges approximately 50% up into the mid-90s. And keep in mind, that is still not even halfway back to the $130 high from March 2022. Oil does not need a geopolitical headline to move higher. This is simply a factor of absolute cheapness, relative to its own history, relative to other assets, relative to monetary degradation. Here is a fascinating data point. The ratio of oil to silver is at the lowest level in recorded history. Partly that is silver's strength, partly that is oil's weakness. But no matter how you measure it, oil is dirt cheap by every metric. And remember the underlying reality in all asset pricing, the degradation of the money unit we use to measure them. The money supply increases roughly 80 to 90% every decade. That reality eventually gets reflected in asset prices. Oil has not reflected it yet. If it did, we would probably be looking at prices in the hundreds. I think oil has turned. And I think you could see significant upward movement without needing any dramatic catalyst. It is simply a pricing correction. Let me zoom out and talk about the broader commodity complex, because I think this is one of the most important investment themes for the next several years. The Bloomberg Commodity Index triggered a major momentum-based buy signal last October above 106. We are now trading around 118, 119. No big deal. It has been a quiet advance. No headlines, no excitement. But here is the setup. Commodities are dirt cheap, historically, even relative to their own price history. They are dirt cheap relative to the stock market. They are dirt cheap relative to gold. Risk is extremely low at these levels. Now, commodities do not always follow gold. Between 2015 and 2020, while gold doubled from 1050 to over 2000, the Bloomberg Commodity Index actually kept going down. No correlation. But that dynamic has changed. It now looks like the broader commodity complex is latching onto gold's coattails. Commodities are going to join the monetary metals in this move higher. And when you look at the components, copper could reach $7, $8, even $9. Base metal miners are acting very well. Oil, as we discussed, has significant upside potential. Over the next couple of years, I believe commodity-related stocks, oil companies, base metal miners, agriculture plays, fertilizer companies will be an outstanding place to invest. Not as a trade, as an investment quality position that could compound for several years. Do not wait for the Bloomberg Commodity Index to take out its 2022 high of 140. By then, everyone will wake up and say, "Oh, it broke out." But the smart money gets positioned when the risk-reward is heavily in your favor, and that is right now. The wave is coming. Get on it and ride it. Let me quickly touch on a few specific commodities people keep asking about. Copper. I would not be surprised to see $7, $8, or even $9 copper. The base metal miners are acting very well, And it is not just copper driving them. Copper is part of the broader commodity repricing story. Lithium. This one has had an incredible round trip. It peaked in 2022 at $80,000 per ton, bottomed at $9,000 in 2025, and now trades around $20,000. I do not have direct analytical coverage on lithium, but the related stocks and ETFs have shown positive momentum recently. It is worth watching. Uranium. We called the uranium bull market very well, getting bullish when it was under $20 back in 2017 and 2018. It ultimately ran above $100. We correctly anticipated the correction from the mid-80s down toward the 60s. Uranium has reasserted itself into a bull trend. But in terms of where to allocate for maximum returns, I think there are better places. Oil-related investments probably offer better risk-reward than uranium at this point. Not that uranium is going down, just that it has already had a monster move from under 20 to the upper 70s and 80s. The easy money in uranium may have already been made. Now I want to address what I believe is the single most important macro development that most investors are not paying enough attention to: the government bond market. And it is measured by M2 in the United States. In January of 2020, M2 was $15.4 trillion. Here we are, 5 years later, and it is well over $22 trillion. That is an increase of 42%. Another way of looking at it, our dollars have lost 42% of their purchasing power in just 5 years. And over each decade, the degradation is roughly 80%. Now, given what is happening in government bond markets, Japan, the United States, the United Kingdom, we are looking at a potential crisis in the one asset class that has traditionally been considered the safest in the world. This is not like a mortgage problem. This is not like a dot-com bubble. This is the government bond market, the key platform asset category that the entire financial system is built upon. It is far bigger than the stock market. Here is what has been happening. The Federal Reserve started buying bonds last November. President Williams of the New York Fed said they needed to provide liquidity. Nice excuse. But look at what has happened since. T-bond futures were at 117. They dropped to the 115 area. And for the last 9 weeks, bond prices have been confined in one of the narrowest ranges I have ever seen, at very elevated yield levels, refusing to rally. Never in the history of T-bond futures have I seen such confined, abnormal activity at high yield levels. It looks like they are keeping the market from collapsing, but they cannot get a rally going. Even when the stock market weakens and money should flow to bonds, it tries to rally and fails. Morgan Stanley's chief investment officer, Mike Wilson, recently said the traditional 60-40 portfolio needs to change. His new recommendation? 60% stocks, 20% bonds, 20% gold. That is a massive admission. One of Wall Street's premier firms is telling investors that the traditional bond allocation is broken and you need gold to replace half of it. That is a crisis signal. And that crisis is already forcing them to print more money, which feeds back into higher gold prices. Bloomberg recently reported that for the first time since the 1990s, gold reserves held by central banks have overtaken U.S. Treasury reserves. Foreign governments are selling bonds and buying gold. That is an extraordinary development. And look at Japan. Their bond market is in total jeopardy. Their new prime minister's platform includes, and I am paraphrasing, "We are going to print more money." That may or may not save their bonds. But it is not just Japan. It is us. We are just not in full crisis mode yet. Our technical analysis says the Fed better keep buying bonds, because if T-bond futures drop 2 to 3 points from current levels, down into the 112 range, it could create a panic. Not just a decline, a panic. And that is the kind of event the Federal Reserve absolutely cannot afford to let happen, because then we enter the Japan Club. And if that does happen, gold explodes. But here is my view. Gold already knows this. It has known it for a decade. That has been the underlying driver of gold's persistent advance. Jamie Dimon said it months ago. You cannot keep pushing this debt problem off forever. Eventually, you have to confront it. And the problem is, it is not being confronted. We are not dealing with a mortgage problem or a tech bubble anymore. We are dealing with a government bond bubble in Japan, the US, the UK, and across the Western world. Once that gets into even the slightest doubt, that is a crisis unto itself. Before I wrap up, I want to highlight one more critical opportunity: the gold and silver mining stocks. The miners have not broken out yet versus gold on a relative performance basis. They have firmed nicely over the last couple of years. They have actually beaten gold's returns. But they are still stuck in a performance range they have been trapped in for 11 years, at extremely depressed valuation levels. Right now, they are challenging the upper end of that range. If they break out, you are going to get a gusher in the mining stocks. And I suspect we are going to see that breakout this year. This is the setup. Miners are leveraged to the metals they produce. When silver goes from current levels toward 300 or more, and gold moves toward 8,500, the cash flows for these companies explode, and they are starting from historically cheap valuations. So here is my personal preference for investment positioning right now. Number 1, silver over gold, vastly, despite the recent drop. Number 2, gold and silver miners over physical gold. The breakout potential is enormous. Number 3, broader commodity-related stocks, oil, base metals, agriculture, as a multi-year investment theme. So let me leave you with this. We are living through a historic repricing event in monetary metals. Silver has broken out of a 50-year trading range. Gold is on its way to potentially matching prior bull market multiples. The bond market, the supposed bedrock of the financial system, is showing cracks that central banks are desperately trying to paper over. Bitcoin's digital gold narrative has been crushed. Real gold and real silver are reasserting their 3,000-year track record as the ultimate stores of value. The pullback we just saw in silver? That is not the end of the story. That is your entry point. Join us at the Virtual Silver Conference, Saturday, February 14th, 8 a.m. Eastern. Free to attend. Replay available if you cannot make it live. Registration link is in the show notes below. Thank you for watching. Good luck in the markets.